Corporate Finance Excel Practice Problem. In this presentation, we will work a practice problem in Excel related to book value per share, earnings per share, and PE ratio. Get ready, because it's time to take a stance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area on the right-hand side. So we're going to be calculating. We're going to take a look at, in essence, a balance sheet calculation so that we can then calculate the book value per share, the earnings per share, the price to earnings ratio, otherwise known as the PE ratio, which we're going to have to back into. So we'll discuss how to kind of back into that, this common kind of book problem, helping us to understand these ratios. And then we have the market value per share to the book value per share. Let's take a look at the information on the left, where we have the information for our balance sheet. We have the assets, liabilities, long-term liabilities, preferred stock outstanding, and shares of the common stock. So we're going to use that information in order to calculate these items on the right. If there is an earning available to common stockholders, so earnings available to common stockholders, we're going to say is 31,900. That's a performance measure, something basically on the income statement that we would basically get based on activity, performance. And then we're going to say that the PE earnings ratio is 23. So they're going to give us the PE earnings ratio. So rather than calculating the PE earnings ratio, we're going to use that calculation to calculate what the price of the stock is, because the PE earnings ratio includes the stock price divided by the earnings per share, which will allow us to back in then to what the stock price is, which is going to be the unknown. This is a calculation not normal. It's normally that we would know the stock price, right, and calculate the earnings, the PE ratio. However, if we can back into it, common book problem to try to back into something like that, and it's useful because it does help us to understand these ratios better, the components of those ratios. And also, when we think about these book problems, we want to refrain from kind of thinking that we have to think of a bunch of different equations, but rather put these items into the equations we know, and then using our algebra will save us a lot of time. So we'll talk about that a bit. Market value per share to the book value per share. Then we'll do a comparison of the market value per share as a comparison to the book value per share, two units of measure that could be used to value the organization on a per share basis. Okay, so to do this, most of this is going to be breaking down balance sheet type of items. So we want to think about our accounting equation, which is going to be assets equals, let me do that again, equals the liabilities plus equity. Or you can think about it as assets minus liabilities equals equity. So again, most people in finance start to think of things this way because that's where they're trying to value. They're looking at the financial statements. From an accounting standpoint, we typically think about it this way, because that's how you would think about the balancing of the balance sheet, assets equal liabilities plus equity. You want to do it both ways. You want to know it both ways, because it's really useful to know this item up top, because you have two sides of the accounting equation, two sides of the same coin. The assets, those assets being owned then by either third-party individuals having claim to the assets, liabilities, the others being equity. So the right side represents who have claim to the assets in essence. Here we're going to give us the value of the organization, which is basically equity. Equity is the value of the organization on a book basis. Once we know the value on a book basis, then we can kind of adjust that and think about, well, what's the value, if we had to revalue anything, and how do we break that value in the equity up to the ownership of the organization, which if it's a corporation, ownership per share, and if there's any preferred stock, we have to deal with the preferred stock. Partnership, ownership per partner. Sole proprietorship, just one owner. So that's fine, right? Okay, so here we're going to go through this. We're going to go through the balance sheet accounts up top. They just gave us the assets, so I'm just going to say assets are going to be equal to, I'll bring this in the outer column because we just have the one number. And then we're going to have liabilities. They gave us a couple different liabilities, so I'm going to put a subcategory, liabilities, colon, to show that there's going to be a subcategory. I'm just practicing the categorization as we work through these. We've got the current liabilities, and that's going to bring that into the inside, because this is going to be a subcalculation because there's multiple liabilities, whereas there's only one asset. Notice how if you think this way, when you start to construct these problems, they'll be easier to just basically construct on the fly or as you go. So then we're going to say we're going to pick up the long-term liabilities. I'll bring that into the enter column as well. The 96,000. Also note if you're doing this by paper and pen or in Excel, if you format it better and you use formulas and then you have a problem and you got to go rework it or think about it in a different way, it's usually easier to do if you formatted it, well. So then we're going to go ahead and say, all right, let's do the total liabilities. Will be on the right-hand side. Total liabilities on the right. I'm going to use our sum function equal SUM shift 9. I'm using the left arrow. I'm using the up arrow, holding down shift, up arrow again. I'm going to move this thing out of the way. There's our formula and enter. I'm going to then underline this item, home tab font group, and then underline. And that's going to be our total liabilities. And then we're going to have the equity. So equity, I'm going to say, is the difference between these items, between the assets minus the liabilities. That's going to give us our equity. And then, of course, if we were to say liabilities and equity, then that would be equaling this and this, which would equal then our total assets. So we're concentrating now on this number. That's where our focus is here. Let's format this a little bit here. I'm gonna select these three because they're a subcategory. Home tab alignment, indenting it. I'm gonna indent this one again. Home tab alignment, indent. Just to categorize that out, we're focusing here on the equity. Then we'll go to the book value per share. So we can calculate the book value per share. We're gonna take the equity, which is assets minus liability. The value of the company on a book basis is the equity of the 218. We don't have any preferred stock to deal with, it looks like this time. Or we do have some preferred stock. We do, yeah. So we have to pull out the preferred stock. They get paid first, you'll recall. So they're not really considered the owners because we kind of consider the common stock people the owners because the preferred stock don't get to vote on things. But they get paid first, so we have to pull their share out. That's why it's preferred. They typically get paid first. And that's going to give us the net worth that's going to go to the common shareholders. The net worth of the total equity that we see going to the actual, what we would call owners. This is going to be the 218 minus the 38.8. And that's going to give us the 179.2. I'm going to underline here. Home tab font group. We'll underline there. Net worth. I'm going to skip a line and we'll put the common stock down here. So I'm going to say common shares outstanding, which I could have said. That's going to be equal to the 20,000. And that's going to give us the book value per share. And that's going to be a division problem. So this will be equal to the 179.2, the net worth assigned to common stockholders divided by the common shares outstanding. Let's format this to give us some decimals. Home tab, numbers group, increasing. Now, again, notice it might not be perfect all the time. It looks like it divides out into dollars and cents well here. So that is nice. I'm going to put an underline here. Home tab, font group, underline. Let's put a double underline here. Home tab, font group, drop down, double underline there. So that's going to be our book value per share, which again, we're going to take the equity section. We got to reverse out if there's any preferred stock, and then we'll divide it by the number of shares, not the number of owners, the number of shares. The owner could own multiple shares and give us our book value per share. Now let's consider the earnings per share calculation, which we have seen in the past. We saw that the earnings were equal to this amount. I'm going to have to type it in there. Let's do this. I'm going to copy and paste it. You'll have to type it in there for you. That's going to be the earnings available to the common stockholders. So that's going to be an earnings, which would be like from the performance statement, like an income statement account. This is going to be equal to what was given to us, the 31.9. And again, that would be the bottom line of the income statement, the performance statement. But then you'd have to take out, which would the bottom line you typically think of as net income, and you'd have to take out any earnings that are applicable to the preferred stockholders. So that would be that number performance statement. And we've seen this calculation in the past. We're going to divide that by the shares of common stock. So shares of common stock is going to be equal to the 20,000. and that'll give us our earnings per share. So the earnings per share are going to be equal to the 31.9 divided by the 20,000. I'm going to add some decimals, go into the home tab. The numbers will add a few decimals. Again, it doesn't have to be exact, but I'll bring it out to 2 decimals. And there we have that. I'm going to underline here. We're going to go to the home tab font drop down. We're going to make an underline here. Let's double underline this one. Home tab font drop down, double underline. So notice this is the book value per share, what you would think where we stand at a point in time. And this is the earnings per share, performance basically number. How did we do over time? So this is a number basically, if we were to think about this, like the value of something, versus how they did, how much they gained, the earning potential basically over time on an earnings per share. So again, the book value is not exact or it's based on book numbers. Yeah, so it's an approximate because the book value could be something different than the actual value if there are any assets and liabilities that are valued at some amount other than what they're on the books for based on the accounting that we have here, right? We do the best we can with the accounting. Some things are on there at historical cost because we can't really appraise them and put them at market value as easily and whatnot. And so there's that, and then the earnings per share, the performance number down here. Okay, so now let's consider the price to earnings ratio, comparing it to the price. Now here we're going to basically back into this. We're going to consider, this is where we consider something to the market price. Remember that the market price is not on the financial statements. The company doesn't determine the market price. The market does that. And we're gonna back into this number. We're gonna say we know already that this number should be 23. Which is going to be the price earnings ratio. So we know the bottom line or the outcome. How do we calculate the price earnings ratio? It's usually going to be the stock price divided by the earnings per share, Now the earnings per share we know is going to be equal to this 1.6. Now also note, and I'm going to add some decimals, home tab, number, add decimals. Now notice it's not really 1.6, it's really 1.595. But if I close it off to 1.6, remember that it's still going to multiply times, because I'm using Excel, 1.595. So I'm going to keep it at 1.60 rounded, and just note that you're going to have to deal with the rounding problems, right? You're going to have to start getting used to rounding. If something's off a little bit, it's because of rounding. These are all estimates for the most part, and therefore rounding shouldn't affect our decision making normally, but we don't want it to throw us off when we try to analyze this type of stuff. So then we got the stock price. Now if you were to calculate this out now I would write it out this way and then type it in a formula, which would be X is the unknown divided by the 1.60, which would actually 1.5, the actual, and that's going to be equal to the 23, and then you could solve for X. I'm going to use this once again using the goal seek, so you can kind of practice using this tool. I think it's really useful. What I'll do is I'll put the formula down here in Excel. I'm going to say I know that this needs to be equal to this divided by this, and so it's 0 at this point in time, and then I'll use goal seek to figure out through trial and error from the computer what that number should be. We're going to go to the data tab up top to do that. Forecast, what if analysis, goal seek. And then I'm going to use this tool. We're going to say I want to set this cell to be, and then I want to set it to be 23. That's what we know it should be. We want to make it 23 using a formula by changing the yellow cell. So set this cell to be 23 by changing the yellow cell. And then it'll use trial and error to figure it out. So there it is, and we'll say okay. Now notice you might get something that's slightly different than if you did the algebra here this way, which equal to 23 times 1.6. And you get 37. If I add decimals, you get 36.8 versus 36.69. Why? Because I rounded this to 1.6, and the real number, we see home tab numbers is this 1.595, right? So then I'd have to say, okay, how about 1.595 if I did this in a calculator? to get to the proper end result. But once again, this may not even round to 3 decimals. It might be some expanding number. So you want to round it to whatever the problem gives it to you to round, or to whatever amount you think is relevant in practice for decision-making purposes. Okay, so then we're going to go to the market value per share to the book value per share. So we'll compare market value to book value. Let's do some formatting here. I'll go to the Home tab, font. Let's underline this one. Let's double underline this. Home tab, font, double underline here. So there's the PE ratio. Then we're going to take the market value per share to the book value per share. So the market value per share is simply the stock price. Where are we determining that? From the market. The market's going to determine that's what the shares are actually selling for if it's a publicly traded company. Book value per share, then, we calculated up top to be the 898. And so then we got the market value per share to the book value per share is going to be, so we're going to go here and say, all right, this will be equal to the 36.96 divided by the book value per share. And so that means that the book value per share, the stock is selling for the 36.96. If I took the book value per share and divided it into the stock, you get a 4.09 times that it divides into the stock value. Now you might say, well, why would that be the case? Why would the stock price be 4 some times greater than the book value? And note, when you're valuing the stock, there's 2 things you're kind of thinking about. You're thinking about, well, what's the value of the company right now? Because it has assets minus liabilities. It has a valuation. In other words, if it was to be liquidated at right now, you'd think I would get some value from that, and just it having that value would be one factor, and that factor would be estimated by the book value, 896. But it also has earning potential, and it may have things that are off the balance sheet that have values such as goodwill, the brand name, including the brand name and whatnot, and off balance sheet items that might have value. And those items could lead to also earning potential. So the other thing you're looking at is what's the earning potential into the future. So therefore, you would think that the stock price, taking into account those 2 things, would be higher than simply the book value of the stock, because there's some value there that has earning potential that isn't included in simply the value of the assets minus the liabilities as a point in time. So that would be, so we have to use these kind of factors when you're trying to value the company as tools, and none of them, of course, are perfect to think about the valuation, and then consider whether the stock price is a relevant or a good reflection. Basically, the stock price representing the market's view as to the value of the organization. A bunch of people getting together, trying to value the stock for their own personal benefit, coming up then with a market price in that way.